Assalamualaikum and good day to our lecturer, Sir Ridwan. We are from Group 7. We'll present about our case study that we choose, the Great Recession in 2007 until 2010, the causes and consequences. My name is FITRIYANI binti MULIANTOH, matrix number 275415, and I am the first presenter. The monetary emergency of 2007 until 2008 accelerated the Great Recession in the United States and caused it to quickly spread to other nations. It began in 2007 and lasted till middle of 2009. In many nations, including the United States, the Great Recession was the longest and most severe economic downturn since the 1930s. Great Depression. The term Great Recession refers to both the 2009 global recession as well as the official US recession that lasted from December 2007 to June 2009. Since 2001, consecutive decrease in the prime rate, the interest rate that banks charge their prime or low risk customers, have enabled banks to provide mortgage at lower lending rates to a significant number of consumers who would not have otherwise been qualified for them. The government introduced a stimulus package to stimulate economic growth by decreasing the monetary policy to expand the money supply. The central banks control the money supply in the market in order to overcome the economic problem.
A very good day to sir. My name is Tanjayu and my battery number is 279013. Now I will explain the issue that led to the Great Recession of 2007 to 2010.
Legal force was the first issue that contributed to the Great Recession of 2007 to 2010. This was because mortgage providers chose to offer mortgages even though they knew the borrower could not afford them, and most of the term of those loans included interest rates that were increased over time. In addition, mortgage providers sold subprime mortgages to banks from these borrowers with impaired credit history, and the bank securitized and sell these subprime mortgages to investors. These participants choose to follow the ultimate investor for their own benefit. For example, insurance companies clearly know that they would not be able to pay default insurance in the event of the collapse in the collateralized debt obligation CDO markets. The CDO markets were at risk of collapse because the bank give inaccurate interest rate when they offering investors a portfolio of real estate mortgages. This is because they analyze interest rate without accuracy when they cannot base on any financial principle. Most investors do not have enough transparency and information to clearly understand the risk of their investment. As a result, this situation leads to an unsustainable component of the financial system. Even worse, when this component collapsed, it will severely damage the entire financial system. Then, the financial institution become insolvent after being negatively impacted. This directly results in investors losing a large portion of their securitized assets. In the end, this undermines public confidence and decreased consumption and investment, leading to economic losses and even a great recession. That's all for me. Thank you.
Hi, a very good day, Doctor. I'm Cindy Golf. Matrix number is 281031. So I will continue to briefly discuss about the problems. So the second problem is global imbalances. Since the middle of this decade, the phenomena of global imbalances have drawn a lot of interest since it reflects a wide range of issues that conventional economic theory is unable to account for. Okay, global imbalances not only cause the recovery for global economy and policy be more complicated, but it will added a lot of uncertainty to recessions of economy as well. This is because the impact is it will lead to occur unexpected ongoing situation, which is really harmful to the global economy. The currency rate, trade flows and investment could all be significantly impacted by the sudden rise in capital volatility. Through some research, some researchers mentioned that the link between currency and global imbalance with the substantial regional differences in the average level of borrowing by nations. Because of monetary policy that with lower saving rates of the developed country, the country itself will used to depend on the capital inflows to maintain its low interest rates. But the global imbalances will occur and lead the developed country at a risky capital outflow. The global imbalances will continue to happen if nations keep lower their currency by jobs and export. And as they increase or decrease with periodic commodity prices, the same goes effect of foreign exchange. Last but not least, the nation debt and the money supply will increase is also due to some investors borrow from the nations with low interest rates and then invest in nations that with higher returns. As a result, capital flows between countries will shift quickly and exchange rate will also change. Okay, that's all from me. Thank you.
A very good day to sir and my friends. My name is CHUAN and my metric number is 281174. I will continue present the part of solution for legal fraud. Countries must enact more effective law to prevent incidents like legal fraud from festering and causing another great recession. First, the US House of Representatives passed a reform bill in December 2009. This bill would creating a new oversight council to ensure that large financial firms do not fall victim to legal fraud again, which would harm the economy. In this bill, the Federal Reserve Board will strictly regulate these large financial firms to prevent them from jeopardizing the viability of the entire system. The Federal Reserve Board's power include dissolving firms that are too big to fail. In addition, the bill also provides the bank shareholder will have the right to vote on corporate compensation package. This provision is intended to correct the traditional large compensation and bonus plan that can lead bankers to make poor decisions. In addition, the bill creates a new Consumer Financial Protection Agency to ensure that potential borrowers are clearly informed of all lending terms and conditions before making a lending decision. The bill also requires new and complex financial products to be explained more clearly to ensure adequate transparency and information. Second, Canada also enacted and implemented legal fraud-related laws in 2008. The purpose was to reduce the risk of consumer borrowing too much in the form of mortgages. This law only covers mortgages that the government agency guarantees. For example, the law reduced the loan-to-value ratio to 95% from the previous 100%. This means buyers need at least 5% down when they take out a loan to purchase a house. In addition, the law creates a barrier that the down payment will not be able to be borrowed separately to prevent 100% financing. Moreover, the law also increased the homeowner's debt service ratio from 40% to 45% to reduce the borrower's ability to repay the debt. The length of time to repay a mortgage in full was also reduced from 40 years to 35 years. Canada also enacted a new minimum standard for loan documentation to ensure that borrowers clearly understand the loan terms. The advantage of having more effective law is the ability to increase transparency to prevent legitimate legal fraud from becoming more rampant. This is because the public will be able to learn not only the basic facts and data, but also the mechanism and procedure used to make decisions and enter transactions. In addition, strict and effective law can prevent financial institutions from working together to commit financial fraud, which can disrupt the financial order and affect the healthy development of the financial market. This could have serious negative effects on the national economy, such as the collapse of the financial system, the Great Recession, etc. The occurrence of information asymmetry can be effectively eliminated if the law explicitly requires all financial companies to disclose information about financial products promptly and effectively. Public skepticism and forecasting error caused by information asymmetry would be significantly reduced, resulting in improved social welfare. However, the disadvantage of having more effective law is obvious. Too strict law can lead to excessive government interference with the freedom of the market. This could disrupt the rules of market operation and interfere with financial flow. Because loans are one of the major capital sources, capital is an essential economic resource. Therefore, if the government passes laws that interfere excessively with the market, a market failure may occur. Inefficient or misallocated resources can occur because the market mechanism does not function adequately. For example, government intervention through law may be difficult or inefficient to achieve the targeted goals due to government enforcement capacity and other constraints, which is the cost of enforcement is too high and has unforeseen side effects on the economy. This would impede the functioning of the economic market mechanism and lead to distortion in the price, supply and demand, competition and risk mechanisms. That's all for me. Thank you.
A very good day to sir and my friend. My name is Pomino, number matric 27961. Now I'll talk about the solution for gold imbalance. Solution is to change the aesthetic supply and demand for international reserve, reduce the world demand for dollar reserve asset. This will alleviate the shortcoming of the dollar-basis global monetary system. There are several measures. First, to reduce the external vulnerability of developing countries and emerging market countries. It can be done in two ways. One, upgrading the industry structure of their country economics. More resilient industrial structure can be led to the more efficient allocation of resources. Efficient allocation of resources contributes to economic goals. Government can promote efficient allocation of resources through free trade agreement, deregulation industry, and so on. In addition, this country can strengthen and promote market institutions. It will enhance the ability to adapt to various external shocks. The second way is increase and promote more international cooperation in monetary and financial fields. It can be moderately reduce the pressure of external shocks on developing countries. The IMF, as representative of international financial institutions, should strengthen the regulation of international speculative capital. For example, the IMF can regulate sophisticated investors to avoid excessive borrowing by investors in the low interest rate countries and lending in the high interest rate country. The IMF also can promote operators of countries around the world in strengthening the regulation of cross-border capital flows in the process of financial market opening. When there is an operator regulation, it will reduce the growth of arbitrated transactions and slow down the change in capital flow. In addition, increase and the occurring of special drawing rights (SDR). SDR draws can be used in supplementing the growth of other reserve assets. It provides many IMF members with reserves that are essentially theirs. Moreover, SDR costs less than the borrowing bull capital market. Plus, SDR can not only be a particular substitute for dollar reserve, but can also significantly reduce the cost of financing for developing countries. This leaves developing countries with less need for international reserve. The advantage of this solution is reduce the current account imbalance between the US and other developing countries and emerging market countries such as China and Asia. Because the US has a large current account deficit resulting in rapid debt growth. At the same time, some developing countries and emerging markets hold large trade surpluses with the US. With this solution, it will mitigate and lower the large US fiscal deficits and balance of payment deficits. This means that the dollar exchange rate will not fluctuate rapidly and dramatically thus creating a serious global imbalance. This will reduce the impact on local currency exchange rate used to change the dollar's exchange rate. Therefore, the rate can reduce between countries when the dollar exchange rate fluctuates due to the hunch fees deficit and balance of payment deficit of the US. However, the disadvantage is the US government will strongly oppose it. This is because this will diminishing the power of dollar. The US dollar bring many economic benefits to the US, at the same time help the US increase their wealth. When the US oppose it, implementing this solution will encounter many difficulties, such as being consistent guard against pressure from the US. In addition, the US dollar is often used as a tool to achieve US qualitative goals. Use it as a tool to put the pressure on international markets. This can cause countries with poor economy to be afraid to make changes at will and demand under the control of US economy. That's all for me. Thank you.
I'm Sumay, matrix number 277474. I will continue present the part of policy that implement in Malaysia to overcome the Great Recession from 2007 to 2010. First of all, let us go through the Malaysia's GDP from 2007 to 2010. The line graph shows the Malaysia GDP growth. In 2007, GDP growth of Malaysia is 6.3%, decreased 1.5% to 4.8% in 2008. In 2009, the GDP growth became negative, which is negative 1.5%, decreased as much as 6.3%. After government Malaysia implements some fiscal and monetary policies, the GDP growth increased to 7.4% in 2010. Therefore, we will continue look the policy that implemented by Malaysia government to overcome the recession. There have two types of policy that implemented by the Malaysia government in order to recover the economy, which is expansionary fiscal policy and expansionary monetary policy. Expansionary fiscal policy implemented by the government is through increased expenditure. Two stimulus packages are introduced under Economic Stabilization Plan. First stimulus package is allocated 7 billion ringgit, which is 1% of GDP. Among the 7 billion ringgit, 4.7 billion ringgit is allocated for the small-scale construction and development projects, while the rest of 2.3 billion ringgit is using for upgrade and repair social infrastructure and public amenities. Second stimulus package is amounted 60 billion ringgit, that approximately 9% of GDP. This package is allocated to several parts, which is 15 billion ringgit by fiscal injection, 25 billion ringgit for guarantee funds, 10 billion ringgit for equity investment, 7 billion ringgit for private finance initiative, and 3 billion ringgit for tax incentive. Next is expansionary monetary policy. Government increases the money supply in the market by cutting down the interest rate. Bank Negara Malaysia decreased the overnight policy rate OPR to 2%, which is decreased 150 basis points between November 2008 and February 2009. The statutory reserve requirement SSR also decreased by 300 basis points. Then, the monthly installment on floating rate loans also will be decreased immediately to ensure the borrowers receive the benefit of reduction rate in OPR and SSR. Finally, in 2009, the direct borrowing share had increased 7%, which is increased from 47% to 54%. In addition, the bank also introduced other complementary measures such as temporary extension of safety net, safeguarding the value of wealth and real income of depositors, and cushioning highly vulnerable borrowers to easing the interest rate allowed the community to continue have access to financing. In short, the expansionary fiscal and monetary policy successfully helped the Malaysian economy recover from recessions as the GDP growth increased to 7.4% in 2010. That's all from me. I will pass to the next presenter. Thank you.
Okay, as a conclusion, the Great Recession occurred in the US started in 2007 and has spread quickly to other countries as well. As we know, legal fraud makes this problem happen as the providers offered mortgage even though they knew borrowers could not afford them. Therefore, the US House of Representatives approved a farm bill in December 2009 to overcome this problem and to make sure that mortgage lenders do not deceive borrowers again. The second issue that happened is the global imbalance that causes the global economy to become more complicated and also triggers the financial crisis. The currency rate, trade flows, and investment could all be significantly impacted by the sudden rise in capital volatility. This global imbalance can be curbed by reducing the external vulnerability of developing countries and emerging markets countries. Thus, in Malaysia, the government has implemented an expansionary for both fiscal and monetary policy to overcome the Great Recession that happened in our country. The expansionary fiscal policy can be done by increasing government expenditure and decreasing tax rates. Malaysia has increased government expenditure during the recession to stimulate economic growth. Malaysia introduced stimulus package that include fiscal injection, guarantee funds, equity investment, private finance initiative, and tax incentive. For expansionary monetary policy, Bank Negara Malaysia controls the money supply in the market by cutting down the interest rate. When the interest rate decreases, the total amount of borrowing will increase and the money supply will increase accordingly. To make sure that people still have access to financing, the bank implemented some solutions such as the temporary extension of safety net, safeguarding the value of wealth and real income of depositor and cushioning highly vulnerable borrowers. Malaysia's government believes that decreasing the interest rate can help the economy's growth and recession will recover. That is all from Group 7. Thank you for listening and have a great day.